Welcome to vTalkInsight, Risk Sentiment Daily for March 20th, 2026. An escalating energy shock out of the Middle East is colliding with increasingly hawkish central bank expectations, just as global equities notch their worst month in more than 3 years and U.S. stocks break below key technical levels. Let's unpack what this means for risk appetite across assets. Risk sentiment has shifted to decisively risk-off, with the latest session marked by broad equity weakness, elevated volatility, and clear evidence of de-risking beneath the surface. Global stocks are already tracking their worst month in more than 3 years. European benchmarks such as the CAC and DAX are down around 10% year-to-date, and the S&P 500 has slipped below its 200-day moving average, signaling a more bearish technical backdrop. The core story binding these moves together is the Middle East energy shock and the stagflation risk it brings. Brent crude has traded in a wide band between about $108 and $119. European gas prices have surged, and the Brent to WTI spread has blown out toward $20, underscoring Europe's vulnerability relative to a more insulated United States. At the same time, central banks are marking inflation forecasts higher and pushing out rate cut expectations, while money is flowing into fixed income and out of equities and risk-sensitive sectors. The result is a market regime where capital is rotating towards safety and liquidity, with investors preferring bonds, defensive sectors, and selected cash flow-rich names over broad beta exposure. The first and most immediate bearish driver is the prolonged Middle East energy shock. Attacks on regional infrastructure have hit both oil and natural gas, including extensive damage to a major Qatari LNG export facility that accounts for roughly a fifth of global supply, with estimates that part of that capacity could be constrained for 3 to 5 years. Brent crude is trading near $120. European gas futures have spiked by more than 20% in a single session, and global annualized spending on crude products has jumped from about $2.5 to $4.5 trillion, approaching levels seen in past oil crises. This is no longer just an energy sector story. It is feeding directly into stagflation fears. Scenario analysis from policymakers highlights that a prolonged period of elevated oil and gas prices would mean higher inflation and weaker growth, with the most severe cases showing persistent energy shocks beyond the forecast horizon. Europe and parts of Asia look particularly exposed, with euro area growth for 2026 revised down to just under 1%. European and Asian equities underperforming U.S. markets, and manufacturing, travel, and mining stocks under heavy pressure. The shock is also cascading through supply chains, from refined products and shipping fuels to fertilizers, where disruptions in places like Pakistan and Bangladesh are driving up corn futures and raising the risk of a second inflation wave via food prices. While some observers argue current price levels are not yet as extreme as the 1970s, markets have clearly shifted from expecting a quick normalization to pricing a longer-lasting disruption. The second major headwind is hawkish central banks and higher-for-longer rate expectations. The Federal Reserve has raised its inflation projections through 2026, now seeing core inflation well above the 2% target, and Chair Powell has stressed that rate cuts are unlikely until there is meaningful progress on inflation, despite acknowledging uncertainty around the impact of the Middle East conflict. In Europe, the ECB has lifted its inflation forecasts for 2026 and 2027 to around 2.6 and 2%, citing energy shocks from the Iran war, while Bank of England officials are signaling a more hawkish bias, with markets now pricing around 50 basis points of additional tightening even as growth and labor data remain weak. Market pricing has responded quickly. Front-end U.S. Treasury yields have pushed up to about 3.8%, their highest since last July. Fed rate cuts for 2026 and 2027 are being priced out, and some contracts now place the first full U.S. rate cut as far out as late 2027. European bond yields have also jumped, with traders swinging from expecting easing to factoring in more than 50 basis points of additional ECB hikes by year-end. Against this backdrop, equity valuations that already looked stretched are coming under greater scrutiny, particularly in the U.S., where risk premia are low and investor surveys point to concerns that the Fed may be unable to ease if oil stays high. That said, policymakers still emphasize optionality. The bar for new Fed hikes is described as high. Euro area headline inflation is currently near target, and scenarios in which energy-driven inflation proves temporary would allow some eventual easing. For now, though, the policy signal is clear. The hurdle for easier financial conditions has risen materially. The third bearish driver is rising credit stress and emerging signs of financial fragility. In private credit, regulators and asset managers are flagging liquidity mismatches and opacity as key concerns. Semi-liquid vehicles are seeing redemption pressure from wealth channels, some have gated withdrawals, and European supervisors are worried about the rapid growth of the sector and its growing interconnections with banks, even though direct bank lending exposure remains relatively small. On the household side, delinquencies in auto loans and credit cards have climbed to levels last seen around the global financial crisis, and rising energy prices near $100 a barrel are adding to the squeeze on lower-income consumers, compounding already sluggish payroll growth. These micro-stress points are feeding into broader market behavior. Financial stocks have been some of the worst performers year to date, with only a small handful of S&P 500 financial names in positive territory, while European banks are under pressure amid stagflation worries and the risk that central banks shift from easing bias back toward tightening. At the same time, significant leverage in the hedge fund sector and its growing overlap with private credit and bank hedging activities raise the risk of nonlinear moves if credit spreads gap wider or redemption pressures intensify. Still, many observers see these as slow burn rather than immediate systemic risks, pointing out that less than 2% of bank lending is directly exposed to private credit and that recent dislocations could ultimately improve terms for lenders. Even so, in an environment of higher rates and volatile energy costs, credit quality and liquidity conditions are likely to be key swing factors for risk sentiment. On the bullish side, an AI-driven earnings and capex boom remains a powerful counterweight to the macro gloom. High-bandwidth memory producers such as Micron, Samsung, and Hynix are seeing robust demand and oligopolistic pricing power, with Micron in particular reporting tight supply across segments and meeting only about half to two-thirds of key customer needs. The company is guided to very strong revenue growth, with third-quarter sales expected to surge well beyond prior analyst expectations, and industry-wide supply constraints in advanced memory are projected to persist until at least 2028. Crucially, hyperscalers remain committed to aggressive capital expenditure on cloud and AI infrastructure, supporting a multi-year investment cycle that benefits chipmakers, hardware providers, and parts of the broader tech ecosystem. This is visible even in mixed market reactions. Micron shares sold off on news that capital spending will exceed $25 billion this year and rise by another $10 billion next year, as investors worry about near-term margins, but the operational story and demand backdrop are clearly strong. In a world of weak breadth and cyclical headwinds, this AI capex engine offers a structural source of earnings growth and productivity gains that can help anchor risk appetite in selected names, even if it does not fully offset macro downside risks. Closely linked to that, resilient U.S. equities and tech leadership form the second key bullish driver. Despite recent pullbacks and a break below the 200-day moving average, U.S. equities have held up better than European and Asian markets, where benchmarks are down more than 2% in the latest session and around 10% year-to-date. U.S. assets, particularly large-cap technology names, are being viewed as relative safe havens in the current geopolitical backdrop, supported by strong balance sheets, resilient cash flows, and ongoing investment in areas such as AI and automation. Fundamentals are still providing support in several U.S. cyclicals as well. Freight volumes have rebounded sharply from last year's recession in logistics, underpinning a more constructive outlook for domestic transport and logistics companies, while many corporates report solid margins and robust consumer balance sheets, even as lower-income segments feel the strain from energy costs. There are, of course, caveats. Valuations in U.S. equities are elevated, risk premia are thin, and strategists warn that if bond yields rise further or geopolitical tensions persist, these markets could see a sharper correction. Even so, In a world where energy shocks are hitting Europe and Asia hardest, the combination of energy independence, earnings resilience, and tech leadership keeps the U.S. at the top of many risk maps when investors look for relative safety rather than outright de-risking. The third supportive driver is a more lender-friendly backdrop for private credit, even as that same space is a source of macro concern. Market participants note that recent dislocations are already generating wider spreads and improved covenant packages, creating a more attractive environment for disciplined managers with dry powder. Base rates are expected to remain well above zero, helped in part by structurally higher oil prices, which enhances the prospective all in returns on newly originated loans compared with the ultra-low-rate years. Importantly, the consensus is not that investors should chase the whole asset class, but that the balance of power has shifted toward lenders who can insist on tighter structures and better pricing. Some large managers remain underweight both public and private credit today, explicitly waiting for further spread widening and stress to create more compelling entry points, while others highlight the likely dispersion ahead between vehicles that maintained underwriting discipline and those that compromised standards during the recent growth phase. In the broader risk picture, this suggests private credit could evolve from a latent vulnerability into a source of resilient income for those able to navigate liquidity and valuation risks, reinforcing the focus on flexibility, contractual cash flows, and careful counterparty analysis. To sum up, risk sentiment is firmly skewed to the downside, dominated by a prolonged Middle East energy shock, more hawkish and higher-for-longer central bank expectations, and mounting signs of credit stress across households, banks, and private markets. Set against that, an AI-driven earnings and capex boom, resilient U.S. tech leadership, and an increasingly lender-friendly private credit landscape offer selective areas of support rather than a full offset to the macro headwinds. The key watch points now are the trajectory of energy supply disruptions, any shift in central bank rhetoric, and how credit conditions evolve as growth slows. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.